Hey everyone, welcome back. Today we're going to talk about being right or making money. A really important chapter in the text, because so much of what we do as analysts, we can get fixated on being right rather than approaching the market and approaching our models in a way of making sure that we're actually making money. You know, the whole point of why we're doing this is to profit out of the markets. You know, again, whether that's directly because you're trading your own account or as a portfolio manager, or indirectly as an analyst that is supporting a portfolio manager. You know, so important that we've got strategies that are making money for us rather than being fixated on being right all the time. And I've seen plenty of those people who love making these really big calls, and they so want to be right, but then it, you know, and they sometimes are, but then it can backfire as well. So again, this is one of the most important chapters that we have here. So really highlighting this, because this really ties together you know, the real important parts of the behavioural finance side as well as we do this. So, bad news about forecasting. Our success cannot be dependent on our forecasts or our ability to forecast markets or predict where they're going. You know, our success has got to be based on statistical testing and knowing that we have a repeatable process that survives all conditions of the markets. Because remember, from our cycles analysis, we can be in different phases of cycles. And maybe a model that works well in one phase isn't going to work well in another phase. So we have to be able to test firstly over all of those phases and then make sure that we've got a model that either adapts or it's a model that we can turn on and turn off, again, very objectively. We use our tools to give us an idea of where the market will go, but we are ready with strategies to react when we are wrong. And you know, I've always been meaning to write a paper on the best traders are losers, because what I've seen is this is where money management comes in. This is where understanding, again, the psychology and everything else comes in, is to know that if I can take lots and lots and lots of little losses, but then when I do win, I win much, much bigger than all those losses combined, well, then I'm going to do very well. And it's just inevitable that we are going to be wrong within much of what we're doing in technical analysis. So important to have good money management rules and realistic expectations. Smarts do not always lead to riches. There's another one there. There are two types of investors, be they large or small. Those who don't know where the market is headed, and those who don't know that they don't know where the market is headed. And then again, there's even a third type, the investment professional who indeed knows that he or she doesn't know, but whose livelihood depends on appearing to know. So yes, it's a little bit of bad news there about forecasting. So Ned Davis from ND Research, you know, he admits very early on that one of his biggest issues that he had to contend with was being able to cut his losses and being able to get out of losing trades. Once he actually developed his timing modules, you know, the stress was out of the market. And you know, I've talked to a lot of quantitative traders as well. Two that jump to mind is Kirk Northington and Carson Dahlberg, who use a very quantitative way of applying technical analysis. And you know, it's basically then the rules are set, and it works or it doesn't work, and there's no emotion tied to it. It's not their decision that led to a good trade or a bad trade. It is the model, and if it was bad, well, then we need to tweak the model. So it takes a lot of the emotion out and a lot of the reasons, a lot of those biases that we'll talk a lot more about in CMT2. Timing models allow for making money on a more consistent basis. And he lists many famous traders who all make money doing that. And the chapter is really good to read, you know, going through a number of the very successful analysts, traders that we hear about on Wall Street, and how they all actually follow many of these rules that we're going to cover. So there's 4 key characteristics, and these are the ones that Ned Davis claim is consistent with all of these group of famous traders. One is that they use objective indicators. You know, there's none of this subjective, I feel like this is where the market's going, or, you know, I've heard some news and I think this is going to be great, or my friend or the cab driver told me about this stock. No, it's objective indicators. They have an objective model built on technical analysis, and sometimes it's an internal indicator, so be it like an RSI or stochastic, you know, it's calculated off the internals of the price chart. Sometimes it's external. So maybe it's something to do with some Fed numbers and some economic numbers, and layering that all in to build the model. Being disciplined, characteristic number 2, extremely important. You know, if we're going to have a model and we're going to be able to test it and know that it works and then use it in real life, we have to remain disciplined. Now, you know, I guess, as I said, the opposite there of discipline is chaos. And again, I've seen so many. I really think about the man who introduced me into the finance markets back in 95 or 96. He was a man who had a great strategy, came up with a great idea for a trading system, but he didn't have the discipline to follow his own system. And, you know, I'd ring him up days and I'd be saying, hey, this is a fantastic day, signal early in the morning, we've been in all day. And he'd be saying, yeah, but I was too scared to take it. And so he never was able to become successful because he lacked the discipline. He had the smarts of an analyst, but he didn't have the discipline to follow his own rules. Extremely important. Now, 3 may seem like a little bit of contradiction. But it's more in the scope of being flexible in terms of if our system stops working, then, you know, we've got to get to that point of saying, well, maybe the market dynamics have shifted and we're in a different phase of a cycle, and now we've got to start looking at, okay, maybe this model has to go sit on the shelf for a little while, or there's a tweak we need to think about, we need to consider long-term trends, or maybe we need to layer in something else into the model. So we've got to be flexible as well to be able to say, we're not getting the results that we expect that we should be. It's time to have a look at this model and see if we can tweak it a little bit. There was an interesting article I read on quantitative analysis, and it was a 3-part article, and she was saying that when they see a model that just stops working, they know that that's actually not necessarily that the model's failing. Her point was that models don't just suddenly fail. What happens is that they just lose their effectiveness over time. And then when that happens, you know, they rebuild a new model or make some tweaks and things like that. And so that's the part of being flexible. It's not as a contradiction to being disciplined, but it's just part of the process, making sure that we are being able to just look and assess and then make adjustments as needed. And then, of course, risk managers. They were all very successful risk managers in what they were doing. Every single investor, successful investor out there, understands risk and understands how to manage that. So we've got 9 rules to consider when building a model. So, you know, what we're really advocating through this course and what Ned Davis is talking about here is this whole thing of, you know, you've got to build a timing model. You've got to build, if you're going to be successful in the markets, you've got to have something that you can hang your hat on and say, this is my model. And, you know, whether you take other people's models and you use some elements of that and build your own, but you've got to find something that suits your style of investing, suits your style of analysis, and you can work on that. So building a model is just so important in what you do. So here are the rules that Ned Davis has come up with. First one is don't fight the Fed, or fight the tape, I should say. You know, when price is going in a certain direction, it's going in that direction. The trend is set, you follow it. You don't fight the trend, it's the other way of looking at that. And so basically what he says is that his models are at least 50% trend sensitive. In other words, if there's a change in trend, his models have to react. If they're not reacting to a change in trend, then there's an issue there, and that's why, as a technical analyst, he really advocates this whole thing of, you don't fight where prices are going. You want to be trading with the prices. You want your model to be adapting as trend changes. So the trend is your friend. We want to go with momentum and listen to the cold, bloodless verdict of the market. Move with lots of confirmation are healthier. So we want confirmation. I think we've already talked about how we have to be careful that we don't seek confirmation in similar indicators. So an RSI and an MACD, they're giving you the same information roundabout. So we don't want confirmation like that. We want confirmation between maybe increases in volume, the direction of on-balance volume and an RSI or something like that. So these are the types of things that are really important. All right, so using moving averages as trend indicators. So when price is above, returns are likely to be positive. When below, returns are likely to be negative. We've covered all of this in the moving averages unit, talking about how the different ways, be it the slope of the moving average is our trend indicator, be it where the price is above the moving average is our trend indicator. These are the different ways that you can use moving averages, and that's exactly what Ned Davis does as well. For longer term, stay with the trend, balancing that with the goal of managing any losses and large losses there. All right, so point number 2 is don't fight the Fed. You've got to basically remain in harmony with the rates. Now, I think we've talked about, I'm getting a little bit confused between CMT1 and CMT2, but what we've talked about in the section to do with confirmation is about how when interest rates are going up, the stock market tends to start to roll over and go down. And so if you see the Fed coming out and they're just raising the rates, month after month, we're getting 25 basis points rises or 50 basis point rises. When the Fed wants to put the brakes onto the economy, well then, in that type of scenario, having a long-only stock-based strategy and continuing to buy into that type of environment would be foolish. What we need to do is understand what's happening with rates, understand what the Fed is doing, and make sure that our strategy is in harmony with that. And it doesn't mean that it's got to be completely quantitative and completely automatic. Your model doesn't have to be like adapting to every scenario. This is that part where we're flexible, and we basically would say, hey, interest rates now are getting up around 4 to 5%. Short-term interest rates may be getting on parity with long-term interest rates. So what we're going to do is now taper off our equity buying, start looking for shorts and start protecting or hedging and things like that. So it's really important that we understand that and follow the Fed. Money moves markets, stay in line with monetary trends. Less economic demands equal liquidity left over for financial markets. For a lot of people, investing in the markets is a discretionary pastime, discretionary decision. If you think of Maslow's hierarchy of needs, I think investing in for future is much lower than meeting the needs of today. So, that's important to keep in mind as well. There's got to be surplus money in the economy for the markets, the equity markets, to rise. Inflationary pressures lead to the Fed tightening. Commodities will go up, gold, etc. Economic ease, disinflation leads to the Fed easing things as well. So the next one we have is beware of crowds at extremes. And again, we've talked about that. We want to go with the flow of where the trends are going. But once it gets to that extreme point, once we get those spikes in volume, once we start seeing that there's just everybody's getting in and it's all over the newscasters and things and everyone's talking about it, then obviously we want to prepare for a change in direction. Liquidity, cash, and psychology optimism inversely correlated, basically meaning that when everybody wants to be part of this security, they want to have it in their portfolio, well, there's no one out there selling, so the liquidity is drying up in that type of environment. Obviously the reverse, when everyone's pessimistic about it and everybody wants it out of their portfolios, there's plenty of liquidity out there. And so they're big drivers of price as well, economics 101. Liquidity is like a shock absorber, so when there's liquidity there, it absorbs a lot of the shocks in the market and things like that. But when there's no liquidity and an event happens, then the price can react very fast. Valuation measures long-term extremes in psychology. So this is just an indicator there, obviously, that based on polling people, so the crowd sentiment is what Ned Davis does. They do a lot of work on surveys and polls and just different metrics, and they use those metrics then in their models as well. And you can see the correlation there between the peaks in the red line at the bottom and some of the peaks and the changes in trend in the price chart there above. As we said before, relying on objective indicators. They don't rely on gut emotions, using a non-emotional weight of the evidence approach and use well-tested indicators. Got to be disciplined. You cannot be disciplined in great things and undisciplined in small things. Already talked about that one as well. Number 6, practice risk management. In the business, we are in the business of making mistakes. That's precisely what we do. We have to take a position. If you want it to be right 100% of the time, you would never make a trade. You would never make a call because, you could be wrong. So we are in a vocation where we are going to make mistakes and we have to be able to deal with that and then practice the risk management around that. Keep mistakes small. Winners make small mistakes, losers make big mistakes. We use stop losses and trend-sensitive indicators to pick up on those. We need to remain flexible. Indicators change as data is revised. As things, and this is more again to do with the cycles. I look at this in terms of cycles and different phases. Everything can change, so we've got to remain flexible there. We use dynamic models like standard deviation brackets. Some of these things we look for, all these bands and envelopes that we've talked about in the past, they come into this model building process, being able to have something which is a little dynamic, rather than fixed and just working along those sorts of lines. We review models on an objective and timely basis. So every model, even if it is successful, you would go back on maybe a quarterly basis and say, now let's go back and have a look at this. Is this as good as it could be? How has it performed over the last quarter? Is it within the range of our expectations? And if it is, then great, we continue on using it. Number 8, money management rules. We're more interested in making money than being right, like we said at the top of this session. Let profits run and cut losses short. Really big issue there. There's an item we talk about in CMT2, which is the disposition effect, which is all about how people have this disposition of, let's just say you've got a portfolio full of winners and losers and you have to raise funds for an event, be it a vacation, be it whatever, you've got to raise some funds. People have this disposition of cutting their winners, selling their winning positions, because they don't want to galvanize the losses if they were to sell their losing positions. And this is very common. Yet the successful traders will cut their losing trades early and let their winning trades run, and hopefully followed by some sort of trailing stop or something like that. But it's so important to really understand where you are in that position and make sure that you're able to identify that and then deal with that disposition as well. Consider cyclical, seasonal, progressive trading patterns that do not add to the models. So just different things that he looks at. And an interesting one actually, buys on rumour and sell on news. Now this is more something that he put in there, and I think it's more to do with, you know, when you hear about that something might be happening in a company, let's just say Tesla might be coming out with a new model, you know, that would be the time to jump in rather than almost waiting for confirmation. So it's a little bit of a contradiction, if you like, to some of the other ways that we approach technical analysis. But it's more along the lines of saying, hey, once everybody's heard the news and everybody wants to be part of that company, then that's the time that you would sell. So that's just one of the rules that he uses there. I think, again, when you come back to the exam, it's these 9 points. You've got to know them, sort of know where they're going. I don't think these specifics are what you would necessarily need to understand. Those who do not study history are condemned to repeat its mistakes. So what we want to do with our models, we want to go back as far as possible. Now, we do a lot of work on this. If you go to optuma.com/pro-web, which is our professional webinars, there's a lot of webinars we did on signal testing. And in there, we do a lot of quantitative testing. And one of the key things that we do is look over a large segment of history and then make sure that it's a neutral, trend neutral period of history. So you take October 2001 through to October 2009. It's an 8-year period, 2 presidential cycles, basically 1 business cycle. We have the S&P pretty much finishing at the same price that it started at. And so it becomes a great section to test over when we're doing model work and building and things like that. So we want to use this idea of a period where there's some bull markets, bull trends, some bear trends and some sideways trends as well. And then we can look at our model and say, well, how are we doing in all of these different phases of the market? So that's the segment there on being right or making money. You know, from Ned Davis. Really strongly recommend that you read that section. You know, of course, we've pulled out the most important things you need to know for the exam, but this is one that will set you up very well for your career as a technical analyst in the long term. So you need to identify those 4 characteristics of those successful traders that Ned Davis talks about, identify the 9 rules that we just talked about there, and then explain also how he uses moving averages as trend indicators. They should be easy for you. We've already talked about moving averages as well. All right, so we'll continue on with the next presentation, the next video. Thank you.